Hi, I'm Bill Blain, strategist with Shard Capital in London. Of course, I'm not in London today, I'm still at home like most other people in the financial markets. However, today I want to talk about inflation averaging. That's going to be the policy that's likely to be announced by Fed Chairman Jerome Powell later this week. Basically, they're going to use average inflation targeting to set interest rates. But for all the economists, analysts, and market researchers who spent their whole careers as Fed watchers, this is going to be a profoundly significant moment. It's basically the end of absolutely everything they've been doing. They've been watching every single aspect of the US economy and listening carefully to everything the Fed says in order to work out exactly how interest rates were likely to move. Although the Fed is going to continue with a 2% inflation target, instead of worrying about its price stability mission, if inflation looks likely to go above their target, then the Fed doesn't need to react by following inflation averaging. Instead, it will allow inflation to remain higher for longer, i.e., averaging for the periods that it's been sub-target. Of course, inflation targeting is just words. It's the meaning that's far more important. And what it actually means is the Fed can simply ignore inflation, and it's signaling exactly that to the market, which means the Fed won't hike interest rates if and when the economy is overheating and inflation rises. The market is going to absolutely love it. Inflation averaging effectively means don't worry about rate hikes or as ever or normalizing interest rates. We are so desperate for inflation, we're going to encourage it and we want markets to love it. It's a way of reassuring markets that there's never going to be interest rate rises to worry them. It magics away the fear of a taper tantrum. It resets the whole game of Fed watching. You won't ever have to worry about interest rate hikes again. It confirms what we've come to understand. In the battle against deflation, the Fed, I guess every other major central bank, sees markets as this weak spot. 10 years of QE and monetary experimentation has done nothing except create massive inflation in financial assets, but no real new demand in the real economy. The central banks are playing catch-up, and they're doing it in markets. They're managing markets to avoid a global market meltdown, which would further drive chronic economic weakness across the whole economy. Economically, the effects of pandering to markets are proving disastrous. Inflated asset bubbles and a massive debt anchor tied around all of our feet. But really, the pandemic has simply catalyzed an economic process and crisis that's been brewing since 2008. It's a culmination of overregulation in the wake of the 2008 crisis, a transfer of risk from banks to the asset management sector, distortions from artificially low interest rates, creating massive price bubbles, as I described, and soaring debt. And what did we get for all that? Deflation rather than inflation in the real world, and that's the major threat. And all this deflation has happened at a time of enormous technical innovation. The rise of the internet is an evolutionary switch from high streets and shopping malls, automation, robotics, 3D printing. There's a host of other life changers underway. The pandemic didn't create them, it's just forcing us to adopt them faster. It's hidden the reality of the growing and deflationary threat in Western economies. Governments are becoming more and more bureaucratic, and companies increasingly debt-encumbered zombies. We haven't learned much from the 30-year Japanese deflationary death spiral because we've been so excited about the potential of the internet shopping, the connected economy, smartphones, robotics, automation, soaring property values, and everything that's been driven the consumption-led economy these last 10 years. Now that economy has been profoundly wobbled by the pandemic, and it's increasingly unbalanced. It feels like large parts of the global economy are flapping uselessly in the wind. Getting the economy back on track after the financial crisis of 2008 proved much tougher than the central banks expected. They know that QE failed to stimulate growth by much after 2008, but they've avoided a succession of embarrassing market collapses for instance, bailing out the banks by making their bond holdings look more attractive. And they've also supported jobs by low interest rates stopping insolvent companies going bust. But despite their best efforts, growth has been anemic these last 10 years. All the pandemic has done has made a bad situation much, much worse. The latest buzz expression going around markets is a K-shaped recovery, explaining why the big five tech stocks have done so extraordinarily well, while the rest of the market is laggards. The real pain, though, is still to come. Banks are simply not lending at present because they are running up rising non-performing loans, and they're trying to keep their capital levels high so they don't upset shareholders or trigger callable capital instruments, COCOs. Governments might do it anyway. That means SMEs are really struggling to get the money they need. Big firms can go to the bond market, which is having a record year. Smaller firms can't. We're going to see that K-shaped divergence increase because SMEs will not be able to access capital. I'm very much afraid that the right investment strategy now is to keep arbitraging the increasingly convoluted mess that central banks have created and are still walking us into. Central banks are trapped in promises of doing whatever it takes and now keeping interest rates low forever because that's what inflation averaging does. And that leaves a massive problem for all investors. The only answer when you face zero interest rates and minimal dividends is to go and seek higher risk elsewhere. And that's why the investment banks are all saying what a wonderful time it is to buy junk bonds and emerging market risk. I'd go and suggest that you hedge all your current arbitraging of what central banks are doing with a healthy smidge of gold. Gold's a great thing to hold when it inevitably all goes wrong. Thank you all very much.